They finally pulled the trigger. For days, we warned you that the commercial banks were cornered. We warned you that as we approached the monthly options expiry, they would attempt one final desperate maneuver to save their balance sheets. We told you they would use the cover of volatility to execute a liquidity flush. We told you they would paint the tape red to convince you the bull market was over. Today, Thursday, January 15th, 2026, they didn't just paint the tape. They set it on fire. Look at the chart. In a matter of minutes, the price of silver collapsed from its morning highs near 93 down to 86. That is a drop of nearly 8% in a single trading session. Let me be crystal clear about what you are seeing. In a normal functioning market, a critical commodity does not lose 8% of its value in 20 minutes. Not unless a mine collapsed, not unless a war ended, not unless a new continent made of silver was discovered. None of those things happened today. The fundamentals did not change. The industrial demand did not disappear. The Shanghai price did not crash. So what happened? We witnessed a paper raid. This crash was engineered. It was a precision strike designed to trigger the stop-loss orders of the retail traders who chased the price up to $92. The banks can see your stop-losses. They know exactly where the pain point is. And today, they drove the price right into that nerve to force you to sell. But here is where their plan backfired. And here is where the story gets terrifying. When a price crashes 8%, what usually happens? Sellers get desperate. Stores put up sale signs. They try to offload inventory before it loses more value. But today, when silver dropped to $86, the stores didn't put up sale signs. They closed the doors. While the algorithms were crashing the price on the screen, something historic happened in the physical world. Something that proves, beyond a shadow of a doubt, that the $86 price is a lie. We have confirmed reports that the United States Mint, the sovereign manufacturing entity of the U.S. government, has suspended sales of the American Silver Eagle and over 37 other numismatic products. Read their official notice carefully. They claim they have halted sales to recalibrate pricing amid surging demand. Think about the absurdity of that statement. The spot price just crashed. It is down. If the market were functioning normally, the mint should be flooded with cheap silver from the Comex smash. They should be lowering prices. Instead, they are telling you they cannot price their products fast enough to keep up. This is a physical default at the retail level. It means that the paper price of $86 is not available to the U.S. government. When the mint calls their suppliers and offers $86, the phone line goes dead. The suppliers are demanding much, much more. And it's not just the government. APMEX, the largest precious metals dealer in the United States, has just imposed a draconian new policy. As of this afternoon, they have implemented a $10,000 minimum order requirement. They are effectively locking out the average American saver. They are saying, if you are a small fish, go away. We only have enough metal for the whales. This is the signal. The screen says $86. The street says sold out. The banks wanted to scare you out of your position. They wanted you to look at that red candle and panic. But the smart money didn't panic. They treated this crash as a dinner bell. The banks have inadvertently subsidized the industrial accumulation of the East by smashing the price to save their options book. They are burning the furniture to heat the house for one more night. Bridge phrase? But to understand exactly why they had to crash the price today, and why this specific move has guaranteed a violent snapback later this week, we have to look at the options trap they built for themselves, because they just turned a financial problem into a mathematical impossibility. To understand why the price crashed today, you have to stop thinking like an investor and start thinking like a casino pit boss. They tell you that markets move based on supply and demand. They tell you that price is a reflection of industrial buying and selling. The reality is, during options expiry week, price is a reflection of bank liability. Let's look under the hood of what actually happened on the trading desk this morning. We are currently in OPEX week, options expiry. This is the week where billions of dollars in paper bets are settled. Heading into this week, the call wall, the price level where the banks had sold the most upside bets to retail traders, was sitting at $90. Think of a call option like a lottery ticket. Retail traders bought these tickets hoping silver would go to $100. The banks sold these tickets. If silver closes the week at $93, where it was this morning, those tickets are winning tickets. The banks, who act as the house, would have to pay out billions of dollars in profits to the speculators. they would be on the hook for the difference between the strike price, 90, and the market price, 93. On millions of ounces, that is a catastrophic loss for their trading desks. But if they can push the price below $90, even by a single cent, those tickets expire worthless. The bank keeps the premium, the bank pays out zero, the bank wins. This is why we saw the paper raid happen exactly when it did. It wasn't random, it was a calculated gamma flush. I want to explain this concept of gamma because it is the weapon they used against you today. In simple terms, when banks sell options, they have to hedge their risk. If the price goes up, they have to buy futures contracts to cover their exposure. This buying drives the price up further. This is called a gamma squeeze to the upside. But it works in reverse too, and today they weaponized it. By dumping a massive amount of paper contracts into the market during the lowest liquidity window, 4:50 a.m. New York time, they triggered a downward spiral. As the price dropped below $92, then $90, then $88, the bank's algorithms automatically sold their hedges. They didn't sell because they wanted to. They sold because the math of their option book forced them to sell to remain neutral. They engineered a cascade. They pushed the snowball off the top of the mountain and then let gravity and your stop losses do the rest of the work. But here's the piece of data that proves this was a trap, not a crash. In a real market crash, when investors are terrified and fleeing the asset, we see something called long liquidation. This means traders are closing their positions and leaving. When this happens, open interest, the total number of active contracts, drops. But today, while the price crashed 8%, open interest actually rose. Let me repeat that because it is the most important data point of the day. The price collapsed, but the number of contracts increased. This is the smoking gun. It means that for every panicked retail trader who sold at $86, someone else, a whale, a sovereign wealth fund, a megabank, was stepping in and opening a new long position. They weren't closing out, they were loading up. They used the bank's manipulation to fill their own bags. While you were panic selling, the smart money was panic buying the discount. The banks cleared their options liability, and the whales cleared the physical inventory. It was a perfect transfer of wealth from the impatient to the strategic. This brings us to the most dangerous phenomenon in finance, decoupling. For 50 years, the paper price, Comex, and the physical price, the street, have been married. They moved together. If paper went down, coins went down. Today, they filed for divorce. They tell you that the spot price is the value of silver. And the reality is, the spot price is just the cover charge to enter the casino. It doesn't get you a drink, and it certainly doesn't get you a bar of silver. Let's look at the forensic evidence from the physical supply chain today. When the price hit $86 on the screen, I called 3 major wholesale dealers. I wanted to see if I could buy a monster box, 500 ounces, at this new discounted price. Dealer number 1 told me, "We are not lowering our ask price. We are holding at yesterday's close." Dealer number 2 told me, "We have suspended taking new orders until Monday." Dealer number 3, APMEX, effectively told the retail public to get lost. Let's dig deeper into that APMEX announcement. Instituting a $10,000 minimum order is not a business decision. It is a survival decision. In the logistics world, processing a $500 order takes the same amount of manpower as processing a $50,000 order. You have to verify payment, pick the metal, pack the box, ensure the shipment. When a dealer is overwhelmed, when they have 100 buyers for every 1 bar of silver, they have to triage. They are cutting off the small fish to save the system from collapsing under the weight of order volume. This is soft rationing. It reminds me of the gasoline lines in the 1970s. The official price of gas was controlled by the government. It was cheap, but you couldn't get it. You had to wait in line for 6 hours. The real price of gas wasn't the number on the pump. It was the number on the pump plus 6 hours of your life. Today, the real price of silver is $8.86. It is 86 gas plus the 34 premium, plus the fact that you need $10,000 just to get a seat at the table. We are receiving verified reports from local coin shops, LCS, across the country. The street price, or the cash and carry price for a Silver Eagle, is holding firm at $120. Let's do the math on the spread. Paper price, $86. Physical price, $120. Spread, $34. That is a 40% premium over spot. In 2020, during the pandemic panic, premiums hit 30%. We thought that was insane. We just blew past that. This $34 spread is the lie tax. It is the market charging you a penalty for believing the Comex price. If you sold your silver today because the screen said $86, you essentially donated $34 per ounce to the dealer who bought it back from you. This confirms that the drop to $86 is a phantom price. It exists only on the leverage exchanges of Chicago and New York. It sits on a server. It is digital. It does not exist in the real world where human beings exchange labor for assets. We are seeing the Venezuelanization of the silver market. In Venezuela, there is the official rate for the bolivar, which the government sets, and the blue dollar rate, which the black market sets. No one trades at the official rate except the government cronies. The entire real economy runs on the blue rate. The Comex is now the official rate. It is a political fiction designed to keep interest rates low and confidence high. The street price, 120, is the blue rate. It is the truth. And just like in Venezuela, once the gap becomes this wide, the system breaks. You cannot maintain a 40% spread forever. Arbitrage, the force of nature in economics, will close it. Traders will buy the paper at 86, demand delivery, and sell it on the street for 120. They will drain the Comex dry to pocket that risk-free 34 profit. This brings us to the ultimate danger for the banks. They smash the price to save their options book, but in doing so, they incentivize the very thing they fear most, the physical run on the bank. By putting silver on sale for $86, they didn't scare away the buyers. They essentially handed out a 40% off coupon to the entire world. And there is one buyer, one massive, insatiable buyer, who just used that coupon to clean out the entire inventory of London. If the domestic premiums aren't enough to scare you, let's look at the geopolitical disaster unfolding right now across the Pacific. While the Comex algorithms in New York were busy smashing the paper price to $86 to save their options bets, the Shanghai Gold Exchange, SGE, sent a message that should terrify every central banker in the West. They didn't sell. They didn't panic. They simply widened the spread. We have confirmed reports that while the U.S. spot price is $86, the silver price on the Shanghai Futures Exchange is still changing hands at over $100 per ounce. Do the math. That is a $14 gap between New York and Shanghai. In the world of global logistics, a $14 gap is not a spread. It is a financial death note for the Comex. By smashing the price to $86, the Western banks have effectively put the entire United States silver inventory on a flash sale for the Chinese industrial complex. Think about it from the perspective of a trader in Beijing. Yesterday, you were paying $100. Today, the foolish Americans are offering to sell it to you for $86. Do you think the price is crashing? No. You think the Americans are losing their minds? You buy. You buy everything. This creates a vacuum effect. Every available ounce of silver in London, every bar sitting in a vault in New York, is now being targeted for export. The arbitrage profit, $14 per ounce, is so massive that it covers the cost of shipping, armored transport, and insurance 10 times over. It is a risk-free trade. Buy a contract on the Comex at $86, take delivery of the $5,000 bar, put it on a plane to Shanghai, sell it for $100, pocket $70,000 profit per bar. The banks think they are saving themselves by crashing the price. The reality is, they're accelerating their own demise. If the price had stayed at $93, the drain would have been slow. At $86, the drain is a torrent. They are incentivizing the very thing they are trying to prevent, the physical depletion of the West. This is why the Shanghai Premium is the most important chart in the world right now. It is a measure of the desperation differential. It shows how much more valuable silver is to a manufacturing economy, China, than it is to a financial economy, USA. China needs the silver for solar panels, and they need it for the energy transition. They view it as a strategic resource. The U.S. views it as a ticker symbol to be gambled on. Today's crash proves that the U.S. market is broken. It is no longer a price discovery mechanism. It is a discount window for the rest of the world. If you think the situation is unprecedented, you need to study history. We are watching a replay of March 1968. Back then, it wasn't silver, it was gold. And it wasn't the Comex, it was the London Gold Pool. The United States and European central banks had a secret agreement to rig the price of gold at $35 an ounce. Whenever the price tried to rise, they would dump tons of gold from their vaults into the market to smash it back down. They did this to make the US dollar look strong. For years, it worked. The price stayed at $35. But then the market realized the US was printing too much money to pay for the Vietnam War. France saw the scam. They started demanding physical gold for their dollars. The demand overwhelmed the supply. In March 1968, the London Gold Pool tried one final desperate smash. They dumped millions of ounces, but the buyers didn't blink. The vault floors were swept clean. The pool collapsed. The market snapped shut for 2 weeks. When it reopened, the price of gold exploded. It went from $35 to $800 over the next decade. What we saw today, the crash to 86 sectors, was the London pool moment for silver. It was the final gasp of a dying manipulation scheme. The banks dumped paper contracts to defend the $90 line, just like the central banks dumped gold to defend the 35 line. But just like in 1968, the physical market has broken the mechanism. The US Mint closing its doors is the equivalent of the London market closing in 1968. After the 1968 collapse, we saw the birth of a two-tier market. There was an official price, $35, that governments used to talk to each other. And there was the free market price, much higher, that actual people used. Look at today. Official price, $86, Comex. Free market price, $120, street. We are already in the two-tier system. The next phase is the total abandonment of the official price. The Comex is about to become irrelevant. The price of silver will no longer be set by paper traders in Chicago. It will be set by whoever has the physical metal. And right now, that isn't us. We have arrived at the conclusion. If you have stayed with me through this emergency broadcast, you now understand the full scope of the deception we witnessed today. You understand that the crash to 86 was a paper raid designed to save the banks from options expiry bankruptcy. You understand that the physical default at the US Mint and the rationing at APMEX prove the real supply is gone. And you understand that the Shanghai Vacuum is sucking the remaining inventory out of the West at a record pace. The evidence is forensic. It is undeniable. Today, Thursday, January 15th, 2026, will be remembered as the day the silver market officially snapped in half. We are no longer looking at a single market. We are looking at two distinct realities fighting for survival. Reality A, the paper world, controlled by algorithms, volatile, cheap, scary. Reality B, the physical world, controlled by scarcity, rationed, unobtainium. The gap between these two worlds is $34. That spread is the lie tax. It represents the extent to which the financial system is suppressing reality. But as we know from physics, pressure builds until it finds a release. So what is the end game? How does this resolve? There are only two ways this gap closes. Scenario 1. The physical price crashes down to $86 to match the paper. For this to happen, Samsung would have to stop building batteries. The Chinese would have to stop accumulating. The US Mint would have to suddenly find millions of ounces of inventory. Given the fundamental data we have analyzed, this is mathematically impossible. Demand is accelerating, not slowing. Scenario 2. The paper price rockets up to meet the physical price. This is the only path forward. The $86 price on your screen is a coiled spring. The further they push it down, the more energy it stores. And when the options expiry passes, when the banks lift their boot from the neck of the market next week, that spring is going to release with violence. We are setting up for a snapback that will take us from 86 to 120 in the blink of an eye. So, what should you do tonight? How do you handle this volatility? First, turn off the screen. The price you see is a digital hallucination designed to extract your wealth. If you sell your silver today because of a red candle, you are handing your family's insurance policy to the very entities that orchestrated the crash. Do not feed the beast. Second, watch the spread, not the spot. The most accurate price indicator right now is not the Comex ticker. It is the street premium. As long as dealers are demanding $120, silver is worth $120. If you can find physical metal anywhere near the spot price, buy it. You're buying $1 for 70 cents. Third, prepare for the government pivot. The volatility we saw today has caught the attention of the highest levels of power. The Pentagon knows that a broken silver market is a national security threat. They cannot build missiles with paper contracts. While the banks are fighting for lower prices, the government is preparing to fight for security of supply. This means the next big buyer won't be a bank. It will be the Department of Defense. And they don't buy on margin. I want to leave you with this. The fact that the U.S. Mint cannot price its own currency's coinage is the ultimate signal. It tells you that the dollar is losing its ability to measure value. When a ruler breaks, you don't blame the object you are measuring. You blame the ruler. Silver isn't volatile. Silver is the rock. The dollar is the thing that is thrashing around, dying. Don't let the thrashing scare you out of the rock. The mainstream media will tell you today was a sell-off. They will tell you the bubble popped. We know it was a raid. If you want to survive the transition from the paper age to the hard asset age, if you want to stand with the few who see the signal through the noise, then you know what to do. Join us, subscribe, and turn on notifications, because the next time I speak to you, the buy button might be gone forever. Stay safe, keep stacking, and I'll see you on the next one.